Well, it's time for Money Tuesday. We know there's a lot of concern out there. Will we get into a recession? A lot of economic analysts believe that we will. So how do you protect your investments if you have a 401k or portfolio? Stewart Welch from the Welch Group joins us now to talk a little bit more about that. Good to see you this morning, Stewart.
Good morning, Mike.
Hey, look, a lot of people, they've been putting their money in these 401ks and they're like, oh my goodness, we have another recession like we had in '08. I'm going to lose a ton of money. I should start right now, start moving stuff.
Well, and actually a lot of people are doing just that.
Are they?
That's what causes the stock market to go down. In fact, last Friday, it crossed into bear market territory. It's down intraday.
Tell folks when you determine it's a bear market.
So bear market is the market's down 20% from its most recent peak. The most recent peak was January the 3rd of this year.
When it was over 36,000.
Yes, it was. And
the Dow, I should say.
Yeah, the Dow.
Yeah.
So it crossed into bear market territory on Friday. It ended the day out of that. But there is a lot of concern. A lot of people are getting nervous. We're seeing people pull money out of the market. So I want to talk about are we going to go into a recession? And if it does, what does it mean? So
yeah, how do we protect ourselves if we do go into recession?
Well, there have been 12 recessions since World War II.
Okay.
And when you think of a bear market, crossing into a bear market, it typically takes about on average, about 27 months to fully recover.
Oh. Excuse me.
A couple of years. So the trick is, the takeaway is the market always rises over time. In fact, it's averaged 11% a year since World War II. So the trick is to be able to sustain yourself during that. So the cardinal sin is you never want to sell stocks when they're down in order to raise cash to pay expenses. So you're going to want to have a minimum of, say, 3 years worth of expenses in some form of cash. So it doesn't have to be real cash. Now, more conservative investors may want to be 10 years worth.
Okay. All right. So and you've told people all along, having that emergency savings fund, that's just so huge, because we know in a recession, people can lose their jobs. That's part of the concern right there. But you mentioned too often that we run for cover. Like I'm so tempted to just take all my allocations now and say, let's just throw this in cash reserve, something safe. Mistake right now?
It is. I think it's always a mistake. So if I look back over my career, 30, 40 years in the business, I've never found anybody who has successfully timed the market as a way to make money in the market. And the reason is, Mike, you have to make two really good calls. You got to make a good call when to get out. You might get out too early. And you have to make a good call getting in. And a lot of people get in way too late. And if you lose that upside, you never recover that money. So I've looked back over people that have done that, and in virtually all the cases, they would have been better off just staying in the market and using that kind of safety net to get them through. Make sure you have plenty of it. So you want to have at least 3 years worth of cash flow that you need to pay bills.
3 years.
And if you're more conservative, you may want to have more than that.
Yeah, and that may be a tall order for a lot of people, but if you can, certainly without that, you want to have that as a goal. But if somebody's really, really close to retirement, give us a window, a time frame, somebody who's close to retirement, and how many years out before they say, yeah, I need to put all that stuff in cash reserves and keep everything safe.
So you probably never have all of it in cash reserves, but as you approach retirement, you for sure want to build up a bigger safety net. So maybe move toward 5 to 10 years worth of safety net, whatever it takes to pay your bills in the course of a year. You're always going to want to be having a portion of your portfolio in the market. That might be 50, 60, 70%, depending on how aggressive you are.
All right. Stewart Welch from the Welch Group. We do appreciate it. All right, we're going to take a break. Got more on the Good Day Buzz just ahead.